Hi everyone, welcome. It's Veronica here. Welcome to week 7. So today we're going to continue with what we learnt last week to create a more sophisticated model. Last week you created an income statement, a balance sheet and a cash flow statement, and they were based on certain inputs. So we're starting with the solution from last week's activity, and I hope you did try it. And if you did, well done if you managed to get something that looks a little bit like these solutions, right? Coming up with our 3 statements. So we're going to work with this today to make it more useful and more functional. And this is going to be important for your assignment, which is going to come up later in the session. When you see that assignment, you'll see that it has 2 parts. And the first one will be to build a model like this. So you're going to be given some information in the assignment instructions, and you're creating a functional model. And what that means is that I should be able to change any input in your model, and we should be able to see the model perform as we expect it to. The second part of that assignment is going to be financial ratio analysis, and that's something that we're going to be discussing in the next few weeks. So you'll be expected to build a model that's similar to the completed model this week. So I hope you'll watch the video closely and that you follow the steps and that you understand what it is that we're trying to do here. Now, I know it's easy to just watch the video and then to look at the solutions, but if you do that, you won't be able to understand it as well as if you actually follow my steps and try it yourself. If we were in a physical classroom, this process would take us a 3-hour seminar to go through, because I would normally be showing you the steps and then waiting for you to actually practice it. And we would be waiting for everyone to be at the same point, and then we'd go on to the next step. But because we're online, we have to do it a little differently. And what I am relying on is that you will look at a few steps, then pause the recording and then try it yourself. And there is a benefit to that in that you can go at your own pace. The videos themselves are fairly short compared to a 3-hour class, but that means that you can take your time, take breaks, go back and repeat a function, listen to it again if it doesn't make sense, but then take the time to do it yourself. Right? And ideally, you need to be replicating what I'm doing. So this spreadsheet is on iLearn for you to download and to try all of the steps as I'm showing them to you. All right, so let's work through this. So when you do come to your assignment, hopefully you won't have any problems. If you can understand what we're doing now, it's going to take less time when you do your assignment later. Right, now I just want to look at this diagram with you. This is currently what the layout of our model looks like. We have our inputs, and from there we build our income statement and our balance sheet. And these are both then used to build our cash flow statement. And we also have this feedback arrow, right, going back into the inputs. So this is where we're able to include any values that we have calculated in the income statement and balance sheet back into the input sheet. So we'll come back to that feedback concept in the last video in this lecture. All right, so just coming back to our inputs here. So at the end of last week, you were given these inputs. Now, these are shown in a slightly different format now, and you can set this up however you like, and that's the same for your assignment as well. So I'm not fussy about the design. You can use whatever font you like, whatever style, but we're always aiming to have professional presentation. All right, looking at our income statement projections here. So we had a whole lot of assumptions about sales growth, cost of goods sold in relation to sales. We had some assumptions about the various expenses and the dividend payout rate. And we also had some assumptions here that are used to value balance sheet items. So if we just look at these first two, we can see that we can use this to help us to calculate the value of the current assets. And we're saying here that we're expecting 60% of sales to be on credit, and that's going to give us our accounts receivable, and it takes 90 days for us to receive the cash from our customers. So if it took our customers exactly 1 year to pay us, then the accounts receivable would be 60% of the sales. But it actually takes 90 days, which is less than 1 year to pay. So the accounts receivable are going to be roughly a quarter of the credit sale. So at any one time, when I look at my accounts receivable, that would represent a quarter of a year of the credit sales. And similarly, with our current liabilities, we know that 60% of the cost of goods sold is actually on credit, and we normally pay our suppliers in 90 days. So we'll pay roughly 4 times a year. So the current liabilities balance will be cost of goods sold times 60% and roughly divided by 4. Right, let's have a look at the balance sheet. We'll just see those figures there. So if I have a look at my year 1 current assets, you can see that we're referring to the sales on the income statement multiplied by the percentage of sales on credit and times the 90-day credit period divided by 365 there. And similarly, with our current liabilities, we're referring to the cost of goods sold on the income statement multiplied by the percentage on credit and multiplied by the payment period of 90 days divided by 365. All right, so the values there are completely determined by those figures. All right, now the other item that we have for the balance sheet is the asset growth rate of 10%. So this is telling us that we need to increase our fixed assets each year in order to support our sales. And there are other assumptions that we could make as well. But let's have a look at this on our balance sheet. So we're looking here at the fixed assets at cost, and you can see that we're growing that previous year's balance by 1 plus the asset growth rate. And you did all of this in week 6. But other potential assumptions that you could make about fixed assets, you could, for example, treat them as a percentage of sales, right? As a percentage of sales, because we might say that if sales is expected to increase, then we should see, a relative increase in the fixed assets to support that growth in the sales. Or we might say that there's a relationship between the net fixed assets and the sales. That's a little bit more unusual, as discussed last week, because we know that the fixed assets are determined by this adjustment for depreciation. And the more depreciation we have, the lower will be those fixed assets. So normally there's not a relationship between sales and how old the asset is. But if it was, and if we did want to use that relationship, that calculation is going to be a little more complicated, because we may end up with what we discovered last week as a circular reference. So we would have to be careful. The best way to get around that problem is to use formulas to calculate the value directly, right? So that the values aren't dependent on each other. Okay, so that's our fixed asset growth. Right, so those assumptions there are our inputs, and from there we prepared our balance sheet, income statement, and our cash flow statement. Right, so that was how we used our model. All right, now, as you were going through that modelling exercise last week, you probably found that you had to keep going backwards and forwards through the different worksheets. So, for example, if we're looking at the income statement, you're referring back to the inputs for some information, and you're also getting some information from the balance sheet items. So you had to keep going, stopping in the middle of your calculation and going backwards and forwards through these other sheets. So, for example, with your interest payment, you would have to be referring back to the balance sheet for the debt. And for the interest earned, you'd be looking at the balance sheet for the cash balance. Right? So going backwards and forwards. And thinking about that actually a little bit further, if I needed my cash balance for the interest earned, remember how you calculated cash? That depended on the total equity. And the total equity value depends on the retained earnings. And the accumulated retained earnings depends on the earnings in that year, which brings us back to the income statement. So, in other words, we have our inputs, we start building our 3 reports directly, then the workflows are interrupted. Right? They're disturbed all the time because you have to keep switching between the different financial statements in order to get the work completed. So it's a very messy workflow. Right? So that creates problems. It's fine to stick to this approach if we have a simple model, right? Or a simple scenario. But once the model starts getting complicated, and by that I mean if we have more accounts with more inputs, and if we have detailed instructions for different accounts, in that case, this model's not good enough, right? Because it's going to get confusing and some items aren't going to be accurately reflected in our model. So that's why we're going to turn this simple model into one that is a little more complex. All right, and we're going to use a different layout. Now, this model you can see on the spreadsheet that you've downloaded. So instead of linking the input directly to the income statement, the balance sheet, and the cash flow statement, we're going to create a calculation sheet, and we're going to call that our model. So we'll calculate all the values that we want for each single account that's going to appear in our statement. So all the calculations will get done in this model sheet. And then when it comes to the presentation of the values, we can then at the very end go to our 3 different financial reports. So in this case, when we calculate the values in the model, we'll be able to keep a smooth cash flow. So we start with one item, then we use other items to calculate it. And when we need the final value, we just go to the 3 statements. So in other words, we are not doing any calculations in our income statement, our balance sheet, or our cash flow statements. All the calculations are done in the model. And then we link the values in the statement to the model. Right, so we update the value in the model with the inputs, right? And then our 3 reports are going to be updated automatically, and that's going to be quite useful. After we do that, then we get some results, and we're going to check those results with some error checking. And we'll also do some documentation so that in the future, when we come back to our model, we'll know what we've done and we'll know where we got our values. Right, then that result, you can see, comes back into the inputs. So we'll actually include those results in a separate table in our inputs sheet so that when we change an input, we can see the direct effect of that on our values. All right, so a much more logical way to approach this. So that's the model that we're going to use this week. It's a bit more sophisticated and it's more functional, right, and more useful. So you can see it's important to understand what we did last week so that now we can take it to a whole new level. All right, so we have our new model. That means I want to delete this original layout. We're not going to use it anymore. But before I do, it's always a good habit to save files from time to time, or different versions of your files. I'm about to delete a whole sheet here, and I'm always a bit nervous to do that just in case I want to refer to it later on. So what we could do is save, right? So I would click on save, all right? And I'm then going to save this document as a new version, right? With a different name. So if I go to File and Save As, right? And then I'll decide where do I want to save this? And I might, for example, save it to my desktop, all right, or wherever you want to on your computer. I might change the name. So I might call this, okay, the FSM model with model, all right, or whatever name makes sense. You might say version 1, version 2, version 3. So this would be version 2. And I save, right? So now I can make changes. I can delete this sheet, but I have saved my previous version. So if I do want to refer back to it later, I have it saved. All right, and so it's a really good habit to get into. It's a good way of documenting your versions, just in case you do make a mistake or you do something wrong, and then you can at least go back to a previous version. All right, so now that I have saved that, I'm going to delete this. So I've just gone down to the tab, I've right-clicked, and I'm going to delete that. And it asks me, do I really want to do that? And yes, I do. So now I've deleted that sheet. And I'm just going to now rename this sheet because it's now no longer layout 2, it's just the layout. All right. So that means I need an extra sheet. I want to make a model sheet. So you can see here, I'm just going to click on the plus and create a new sheet. I'll rename that and call it model. And I want that to sit in between, I'm just dragging it across, in between the inputs and the income statement, because that's where it appears in that layout diagram. Right, so I need some information here to go into my model, and I want it to look like the same format. So this is a good starting point, the same format as my income statement. So I've just gone to my income statement worksheet, and I'm just going to do Control-C, copy that, and Control-V into my model sheet. And I'm just going to change the width of my columns a little bit. I might just make these ones a bit smaller. Okay, and I'll make this whole thing a bit larger so that you can see it. All right, so here is my income statement information. And remember, the idea of this model sheet is that I don't want to have to keep going back to my other worksheets. So I want to adjust my formulas here so that I'm only referring to information on this same sheet, right? Don't have to keep going elsewhere. So if I look at sales, I'm just going to work my way down. But if I look at sales here, I can see that it's the previous value times 1 plus the sales growth. Now that's fine. I can keep that as it is. It's not referring to any other worksheet. And same with my cost of goods sold. It's just the previous value times the growth rate. That's fine. And same with operating expenses. It's times 1 plus a growth rate. In this case, the inflation rate. But when I get to the interest payments, as we saw before, we look at the formula and we can see that it is linking to the balance sheet. I actually don't want that. I don't want to have to keep going back to the balance sheet in the middle of my calculations. So what I want to do is find that information, and that is actually referring to the debt, right? It's the debt of the previous year times the interest rate. I'd like to have the debt here on the same sheet so I can refer to it here. Okay, so that's what I'm going to do. I'm going to go to the balance sheet. I'm going to find my debt, right, and the values that go with that. I'm going to copy it and I'm going to put it here. I'll just Control V to paste that. I'm going to put it here on the same worksheet. And for my interest earned, same thing, right? I need to refer to the cash and marketable securities from my balance sheet here. So I'm going to go to my balance sheet and find that. I can see it up here. I'm just going to copy that and I'm going to paste it. All right, now don't worry about the fact that you have zeros here. That's fine. We're going to be updating that later on. Right, so now we have those two pieces of information. Let's just update our formulas. So I want to delete that reference to the balance sheet worksheet, right? So I'm actually going to delete that part of the formula and I'm going to replace it with the cell reference for the debt down here. And in my assumptions, it tells me that this interest payment is going to relate to the previous year's debt. So the cell reference is going to be the year zero debt, and you can see that in here now. So when I enter, I get the same value as on the balance sheet, right? But instead of referring to the balance sheet, it's referring to a cell here. And I'm just copying that across. So if I click on any of these, I can see it's not referring to, so the balance sheet, it's referring to the appropriate figure here on the worksheet in the model. So we'll do the same thing for the interest earned. So this is referring to the cash and marketable securities on the balance sheet. I want to get rid of that reference to the balance sheet and replace it. And again, it's the previous year's cash and marketable securities, and enter. And I'm going to copy that across. Now, again, don't worry about these zeros. That's because it's referring to these cells in row 23 that are zeros. And that is going to be updated later. The main thing we're trying to do here is just get our formulas in so that when we do update these figures, it does automatically feed into our model. All right, so the next thing to deal with is depreciation. But before we do that, I'm just going to insert some rows here, right? So I'm just selecting these rows 11 to 18. And I'm just going to click on Insert, right, up the top in the menu. All right, and I just want to do that because I want to calculate a subtotal here called EBITDA, which is earnings before depreciation and amortization. And this is going to be a useful subtotal. So all I'm going to do is just auto sum here. It's a useful subtotal, and we'll see that later when we're doing some financial ratio analysis. And just with formatting, because it is a total, I'm just going to go up to the borders here and I'm going to put in a top border, right? So you can see a border there, which shows me that this is a total of the values above that line. And if I now just copy this across, it's going to take the formatting with it as well. So you can see that we have that nice line there. And I might just tidy that up because I don't actually want that shading. So I can just go to fill here and say no fill. All right, so there we go. We've dealt with the top part of the income statement. Now we want to look at the depreciation, and we notice that again, there's a reference to the balance sheet here because depreciation is based on the fixed assets. So I'm just going to go to my balance sheet and find all of the information about the fixed assets. So I'm actually going to select all of this information here. Right, the cost, the accumulated depreciation, and the adjusted value, which is the net fixed assets. And I'm just going to copy that and we'll put it here. I'm just going to leave a blank row there, and I'll paste it in here. All right, so just to make this a little more logical, I'm just going to rearrange it a little bit. So I'm just going to take the accumulated depreciation and the net fixed assets. I'm just going to move them down a row, and I'm going to take my depreciation and shift it up into that gap. All right, this is just going to make my calculations a little more logical. All right, so let's have a look at the numbers. We want to take out any reference to any other worksheet. So if I look at the value at cost, this looks fine. It's not referring to any other worksheet. It's just the value at the beginning times 1 plus the growth rate. So that one's okay. But when we look at our depreciation, we notice that it is referring to the balance sheet. All right, now I don't want that. And we do know that depreciation is based on the fixed asset at cost, which we now have. So we can replace that. All right, so we're going to replace that with the, so let's, first of all, let's just get rid of that reference to the balance sheet, right? And we'll replace that with, it has to be the cost from the previous year. Right, that's what the depreciation rate is based on. Okay, so that gives us our depreciation for year 1. I'll just copy that across. All right, so when I click on any of these, there's no reference to the actual balance sheet tab. It's referring to the value here. Accumulated depreciation. All right, so accumulated depreciation, this is referring to the income statement. It's referring to depreciation on the income statement. So accumulated means it's adding on to the previous year, right? So referring to the previous year's balance. Let's get rid of that income statement reference and replace it with our depreciation here. Okay, and we'll just drag that across. Okay, so all of my formulas here should be referring to the depreciation on this worksheet. Fantastic. Now, our net fixed assets, let's fix those up. So we'll start from year 0 here. This is not going to be correct because we've inserted that depreciation. So thinking carefully, what is your net fixed assets? It's the value at cost. So let's get rid of this formula. All right, it's the assets at cost minus the accumulated depreciation. So that's already a negative. So I'm going to be adding that negative. So cost minus accumulated depreciation. And we can, we can copy that across. Right now, I want to show that that's a total. So what we could do again is put our top border in there. And I also want to get rid of that shading. Actually, I'll just get rid of the shading for these ones, just to neaten up that formatting a little bit. Great. So we've dealt with quite a few income statement items, and we've also dealt with our fixed assets. Let's keep moving down. So looking at our profit before tax, let's just make sure that this is calculated correctly. All right, and it's not, is it? So we're going to have to adjust that because we've inserted all of this new information. So let's just fix this up. So our profit before tax is going to be our earnings before depreciation minus our depreciation. And depreciation is already a negative. So I'll add, oops, wrong one. Okay, the depreciation. There we go. So that should now give us our profit before tax. Okay, let's just drag that across. And let's also, we can just get rid of that shading. All right, so profit before tax is done. Taxes, let's just have a look at taxes. We want to make sure that, or actually we'll leave that because that's the actual value. Let's have a look. So this looks fine. It's not referring to any other worksheet. So it is, yep, the profit before tax times the tax rate. That looks great. So we can keep that as it is. Right, and profit after tax, yep, that looks fine too. Profit before tax less the taxes. Great. All right, now we can do a little check before we do go on. One thing that we can check that we've done correctly is our calculation of our net fixed assets, just to make sure we haven't made any mistakes here, because this value for our net fixed assets should match what we have in the balance sheet. So you can see it's 770, and if I look back at my balance sheet, yep. So even though I made all of those changes and rearranged things, I'm still getting the right value there for my net fixed assets, and my depreciation must be correct as well in that case. I can't check my profit after tax yet. It won't match the income statement because I haven't updated my interest yet. All right, so that interest earned still needs to be fixed up, which we will do in a moment. Okay, now what else do we need to fix up? We need to fix up these equity items. Pardon me. So with the dividends, let's have a look at dividends here. Make sure we don't need to change anything. That all looks good. It's not referring to any other sheets, so that's great. Retained earnings, we will have to fix, right, because we want that to be updated. So I want to go to the balance sheet here, and I'm going to select all of these equity items from the balance sheet. Okay, so we've got all of those 3 items, and I might actually, before I do paste them, let me just going to insert these, and notice that that does automatically insert what I just copied, because I should have waited to copy. All right, so I've just moved that over. So probably a better way for me to have done that was insert my rows before I copied and pasted that balance sheet information. But I did get there in the end. So having a look at the information that we have, let's just make sure that we have the right formulas here. So capital looks okay, right? Accumulated retained earnings, we're going to have to fix up. So I'm just getting an overview of what needs doing. All right, so I want to rearrange things a little bit just to fix all of this up and make it look logical. I'm going to take the accumulated retained earnings here, and I'm going to shift it up into that gap that I left, right? Because I want to just match that up with the retained earnings. And I'll just delete this blank row here. All right, so I've really just changed the order a little bit. All right, so we've already checked dividends. They look okay. Retained earnings is not going to be really useful in its current form. So we're going to instead focus on accumulated retained earnings. And when I clicked on that before, we noticed that there's a reference to the income statement. So let's think about what that's representing. Accumulated retained earnings is the retained earnings in the previous year plus the earnings for this year. So this would have been the profit after tax figure, right? But we already have, and it would be the profit after tax minus the dividends, but we've already worked that out in the retained earnings balance. So what I'm doing here is I'm taking out that reference to the income statement, and I'm going to refer to the retained earnings for this year, which is the profit after tax minus the dividends. You can see that there, right? It's the profit after tax minus the dividends. And I'm going to copy that across. Okay, so there is the accumulated retained earnings. Now, capital's fine. It hasn't changed, right? It's just the same as the previous year. So we can keep that the same. Now, we will have to adjust total equity here because we've rearranged everything. So let's delete that formula for the total equity and think about what it includes. It includes the accumulated retained earnings, which remember includes retained earnings and dividends, so we don't want to double count those, and we add our capital. Okay, and then we can just drag that across. Right, now that we have done that, we can move into working out our cash and marketable securities, because remember, the cash and marketable securities depends on the total equity, right? And remembering that from last week, right? So that's an important point to remember. So just remembering as a recap, our accounting equation. So our assets equals our liabilities plus our equity. Right now, if I want to find my cash and marketable securities and I'm starting with the total equity, what I'm going to need to do is to add back any liabilities, right? So we have some current liabilities. Oh, actually, you know what? I can't do that yet. I have to find my current assets and current liabilities to do this. So that's actually a good illustration here of realizing when you need some other items from the statements. So I know my current liabilities are on my balance sheet, but I haven't brought them over onto this sheet yet. So I'm actually going to do that now. I'm just going to insert a couple of lines. Actually, I probably don't need that many. All right, I'll insert just two rows there. Go to my balance sheet. Let's find our current assets. Copy that. Just paste them in here. And I'll find my current liabilities because I'll need them for this next process. All right. Now, again, don't worry about the values here. It's not important. That will all automatically update in just a moment. All right, so your cash and marketable securities, let's go back to our formula. So we know that it's equal to the total equity, and we're going to add the current liabilities, plus we're going to add the long-term debt, which we have right above. Right, just remembering where we put everything. And we're going to subtract the current assets and subtract the net fixed assets. Okay, so that is now giving us our cash and marketable securities. Fantastic. So we'll just drag that across. Oh, actually, our debt is missing one figure there too. Okay, so now that we have updated that, now you know what? There is one thing we need to do. We need to just fix up our current assets. Forgot about this one, so let's go back and do that now. So notice that there is a reference to the income statement here. So we do want to get rid of that. And this goes back to the very first point we were making at the start of this recording, is that our current assets are based on credit sales. So we need to replace that value from the income statement. Let's get rid of that. And let's replace it with the sales that we now have. All right, so now we have our current assets. And same with our current liabilities. Remember, there's a reference here from the income statement to cost of goods sold. So let's delete that and replace it with the cost of goods sold for this year. And we'll drag that across. All right, so I did do that out of order a little bit. Let me get rid of that. So we did do that out of order a little bit, but because I was careful in putting my formulas in, now that I've updated the current assets and current liabilities, that has now automatically updated my cash and marketable securities. So just to repeat what I did there, so I had my total equity, I added my current liabilities and my debt, right? And I subtracted my current assets and my net fixed assets. So that's what gave me my cash and marketable securities. And now that I do have all of that, notice that automatically my interest earned has now updated because I did have my formulas in there correctly. Now we should have the correct profit after tax. And now we can go back to our income statement and just check that. So 237 for year 5. If I look at my income statement, that is exactly what we had in our income statement. So we've now transferred across all of the information that we need to prepare our income statement and our balance sheet. So this is now going to create a much smoother workflow. We're now not going to do anything in the income statement and balance sheet until the very end. So things that we still need to do, and we will do in our next recording, is we still need to prepare our cash flow statement, and we also need to look at transferring that information and linking the statements to this model. All right, so I'll see you in the next recording for that.